Are you tired of blowing trading accounts? Well, listen to this. 97% of traders that trade US30 will blow their account within the first 5 trades that they take. Let me show you how to use proper risk when trading US30 so you avoid ever blowing a trading account. If you do want to be mentored by me, I did just open up my one-on-one mentorship. All you have to do is DM me on Instagram. There should be a link below where you can find my Instagram. And if you guys could show some type of love, like this video, drop a comment below, even if it is an emoji, still counts and I would appreciate that. And if you're new to my channel, hit that subscribe button if you are not already subscribed. Now without further ado, let's get into my computer. Alright guys, let's get into the juicy information. I want to start with the lot size that you guys should be using for Hugo's Way and FTMO. I know a lot of you are trying to pass challenges and you're probably wondering, yo, how do I know what lot size to use and all that stuff? So we're going to go over that in this video, and this is going to be super helpful because instead of you having to go on a demo account and figure out what lot size to use and all that information, let me just show you what lot size to use. So most of you are using Hugo's Way. If you need to sign up for Hugo's Way, click the link in my description. And this is the lot size. Now, when you have US30 when you could trade US30 with Hugo's Way, you have to use a very tight stop loss. Now, we all know US30 is extremely volatile, and it's hard to use small stop losses where you're just going to get stopped out and then it goes in the direction you want. So with a $1,000 account, you're going to use a 0.01, and that is still risky because if you have a $500 or if you're using a 500 pip stop loss, you're risking like 5% of your account. If you have 5,000 in your account, a 0.05, that's still pretty risky. When you have $10,000 in your trading account, you can use a 10 lot, but at the same time, or 0.10 lot, a 10 cent lot, at the same time, that's still going to be pretty risky, and I'm going to tell you exactly why in a second. But if you look at FTMO, the lot sizes right here, we can see with a $50,000 account, you're going to be using a 5 lot. So if you catch 100 pips, you're going to make $50. If you catch 1,000 pips, you're going to make $500. And that's where it gets fun when you're trading with these funded accounts because you have much more leverage. You can use higher lot sizes, and obviously with bigger lot sizes, you're going to see bigger returns. Now, if you have a $100,000 account with FTMO, you're going to be using a 10 lot. And guys, these lot sizes are applicable with my forex funds as well. They're the same lot sizes. If you have a $200,000 account, you're going to be using a 20 lot. Now let's go over the examples, and I mean like the percentage examples for Hugo's Way. This is very, very important information I'm about to disclose to you guys. So if you have a $1,000 account, like I said, it's pretty risky. If you're risking 5% per trade and you use a 0.01 lot size, you're going to have a stop loss of 500 pips. So if a trade hits your stop loss for 500 pips, you're going to lose $50, which is 5% of your account of $1,000, which is a good amount. I know when I'm trading, like I want to be risking 1 to 3%. So when it comes to Hugo's Way, you can trade other pairs, or you can trade indices like US30. I would definitely start with the S&P 500 though, or NAS 100 if you're going to trade indices. Grow your account to a couple $1,000s. Then once you have like 10K, then you could use a 0.01. You could have a stop loss of 1,000 pips. If it hits your stop loss, you're only going to be risking 1% of your account. So really be smart when it comes to trading indexes, because this is how a lot of traders blow their account. They think that US30 is like forex pairs, and they go and trade US30 like it's a forex pair. They drop like a 10 cent lot with a $1,000 account, and then boom, it goes negative, blows their account within seconds. Like, wait, what? So it's very important that you're informed of this information because it's super important. Once you have like $5,000 in your account, if you're risking 5% per trade, you would do a 0.05 lot with a 500 pip stop loss, and your loss is going to be $250. Now, if you have a $10,000 account and you're risking 1% per trade, I know I didn't put it, but if you have a 0.01 lot, with 1,000 pip stop loss, you're only going to lose $100. So that's 1% of your account. Now let me show you the FTMO examples. If you have a $50,000 account and you're risking 1% per trade, you'd be using a 5 lot with 1,000 pip stop loss, and your loss is only going to be $500. Not bad at all. And I know that I'm talking about, yo, this is going to be your loss, but we need to always think as the worst case scenario. It's like when you go on an airplane, they're telling you all the precautions. Okay, we have an exit right here. If in case of emergency, your vent thing is going to come down, your mask is going to come down, make sure you put it on yourself first before you put it on another person. So we really have to go over all the precautions when it comes to trading, especially when it comes to like lot sizes, because a lot of traders do not know this stuff. And they're wondering why they're blowing accounts, why they're losing so much on a trade, because they aren't properly informed. So I hope this video is helping a lot of you out. Well, with FTMO, if you have a $50,000 account and you want to risk 1% per trade, I'll do a 5 lot with 1,000 pip stop loss. You're only going to lose $500, or you're going to make $500. So if you want to be risking like 2% of your account, you would just double up your lot size. If you're going to do a 10 lot with 1,000 pips, you would lose $1,000. Now with a $100,000 account, if you're wanting to risk 1% per trade, you would do a 10 lot with 1,000 pip stop loss, and all you're going to lose is $1,000 per trade. So when we're trading, we obviously want to have like a higher risk reward ratio where our stop loss is smaller than our take profit. So we would have a stop loss of, let's say, like 1,000 pips, and our take profit's like 2,000, 3,000 pips, so we can be making money long term. Because so let's say that our win ratio is 50%. We are 50% profitable with our strategy. So let's say we take 10 trades, 5 of the trades are wins, 5 of the trades are losses. If we use 1,000 pip stop loss for every one of those trades, and 5 of those trades hit our stop loss, boom, we're down 5,000 pips. But let's say that our take profit is 2,000 pips, and we still win 5 out of 10 of those trades, we're still going to be up 5,000 pips. So that's where it's really important that you're using the same lot size per trade, every trade. You're using the same stop loss, so you're really going to be fine. You're at the end of the week, end of the month, end of the year, you're still going to be profitable. Okay? With a $200,000 account, you're going to be risking 1% per trade. You would do a 20 lot with 1,000 pip stop loss, and you're going to lose $2,000. Now let's go to the chart. Let me delete this since you guys already have it. And let's go over an example. So let's go to US30 right here. Let's put it in replay mode just so it's a little bit real for y'all. Okay, so looking at US30, we're in a downtrend. Previous New York session dropped lower. Asia session kind of tried to break high, consolidating. My bias is to obviously go short. We do have this bearish candle that closed at 715. So let's go right here, and if we're going to sell, let's go over like the pip amount and everything like that. So right here, we can see in the middle, we have these numbers, 532. That's 532 pips we are risking. This number right here is our stop loss. So let's drag it up to like 1,000. Boom, 1,037. And then let's drag this down here to this level right here, 1,568. So we know if we have a $100,000 account with FTMO and we're using a 10 lot, we're potentially going to lose $1,037. And it's crazy because a 10 lot with FTMO, $100,000 account, equates perfectly to these numbers. So whatever the numbers are right here, the pips counted, is going to be how much you're going to lose on our 10 lot. Then right here, we have our TP at 1,568 pips. So if this trade does hit our take profit, which we want it to, we're going to make $1,500, $1,568. There we go. There's a correct pronunciation. So we really need to make sure that, like I said a second ago, our risk reward ratio is always higher. So we have a 1.5 risk ratio. So our TP is about 1.5 times bigger than our stop loss here. But look at the risk reward ratio as it's going to change as we bring it down. So now it's a 2. We can make it a 3 if we want. So once your TP gets bigger, Boom. So we have a 1 to 3 risk reward ratio. Our stop loss is 1,000 pips. Our TP is 3,100 pips. So it's 3 times bigger than our stop loss. So let's say we're going to take this and we're like, hey, we're risking, let's say we're trading on a $100,000 account. Let's say we're risking $1,000, but yo, we have the potential to make $3,000. So let's play it back. Set and forget your trade. You're in profit. Boom, you're in profit. Boom, profit, profit. TP hit. In a matter of like an hour and 15 minutes, hit your take profit. Yep, an hour and 15 minutes. So I hope that you guys enjoyed this video, got some value. What I would do is rewatch this to understand it a little bit more. I know these lot sizes and percentages and all this stuff is confusing, but it's very important to understand. Hope you guys enjoyed this video. I'll see you in the next one. Peace out.